Hey everyone, welcome back to the Finance Things in Life. I'm Matt, along with my brother Anthony, and we're from the PD Group Wealth Management. Today we're going to be talking about tax loss harvesting.
I do want to point out for those of you that are watching, we are aware that we are matching, and we probably do this once a week.
At least once a week.
Unintentionally, I do not text him in the morning to ask him what he's wearing. It's just that connection, I guess.
Yeah, that brotherly connection.
Yeah, so we are aware that this has happened, and unfortunately, you're all going to be a part of it as well.
So welcome.
Welcome. I just want to get that off my chest.
So here, as we approach the end of the year, this is something that we work with clients a lot with. It's especially in a year this year where we've had gains in the markets. A lot of people have realized gains, and so now to kind of minimize their tax burden, we're looking to offset those gains as much as possible.
And a realized gain is a gain that you have sold.
Correct. So in a taxable account, so we're not talking about your IRA accounts, we're talking about brokerage accounts. A realized gain, so let's say you held ABC company stock and you paid $3,000 and you sold it for $5,000. You have a $2,000 realized gain, and you are going to have to pay tax on that realized gain. So now what we're looking to do is offset some of those gains to minimize your tax burden.
Yeah, so like Matt was saying, this is something we look to do at the end of the year, just analyzing what gains you've had or what losses you've had and what investments, and just planning for future years. So if you've had a loss in something, you're able to do what's called a tax loss harvest, or we can call it, I guess, tax loss harvest is the word for it. Where we're essentially going to sell that investment and buy back a similar one. So then you're able to capture that loss, and then you're not out of the market for an extended period of time.
Yeah. So what you can do is, there's obviously a number of different ways to do this, but if you have ABC stock and you sell it, you're not necessarily able to buy the exact same stock. You have to wait 30 days in order to buy it back. But in the meantime, you can buy something similar. So if it's in the tech sector, you can buy another tech stock, or commodity or anything else, and you can kind of stay invested. If it's an ETF that's like based on the S&P 500, you can sell, an S&P 500 ETF and buy a different S&P 500 ETF and not have anything where it's called the wash sale rule, where you can't buy that position back within 30 days.
Yeah, so the nice thing about this is you're able to offset those losses in the year, and then you're able to push those losses out further, I guess, extended throughout the future.
Yeah, so essentially it's indefinitely.
Right, indefinitely. And you're able to extend those $3,000 per year.
Yeah, so you can max loss that you can have for the year is $3,000. So, if you had, let's say you had $20,000 in gains, and then you're going to offset those gains with $30,000 in losses, that you're going to net $10,000 in losses, but you can only use up to $3,000 for that given year. So the remaining $7,000 will then be carried forward for future years if you need to offset more gains. So.
Yeah. So if you've had a large gain in that year, let's say you sold either an investment or some property or something where you're going to have a large gain in that year, you could look to this tax loss harvesting strategy and say, well, let me look at my investments. Maybe the S&P did really poorly this year, but I don't want to be out of the market. I'm going to take my losses in the S&P, buy something similar in the similar investment with the S&P, buy a similar investment that still tracks the S&P 500. Take those losses to offset my gains, and then still stay in the market.
Yeah. And when you should do this, volatile markets are a great opportunity to do this strategy. Any year that you have maybe significant income or gains, you should look at it throughout the year, or, especially as you get to the end of the year, to kind of offset those gains. So we kind of look at this strategy, especially in December, to do this just to kind of clean up things at the end of the year. Or, like I said before, volatile markets offer opportunities throughout the year as well.
Yep. And again, this is not for your IRAs or any kind of retirement account. Those do not have the same effect. It has to be a brokerage account or some kind of taxable account.
Yeah. We have an example or, story with tax loss harvesting.
I mean, I kind of alluded to it earlier. I had a client that sold a property and had a fairly large gain on that property. And we were just trying to figure out ways that we were able to, pay less taxes. We're not going to evade taxes, but we want to pay less as possible. So we took a look at the brokerage account, and we found some investments that had some losses throughout the year, and found some investments that were a similar strategy. And we were able to deduct some of those gains that he had. It's definitely one of those options that people tend to forget about. So just having that resource to you, or just the wherewithal to look there, is a good benefit to have.
And a lot of people think if they sell the position, then, they're not going to be invested anymore. And so, that's where it comes into play, finding, a similar investment or a strategy that's, going to kind of keep you invested so you're not out of the market for a period of time. Because, the point is to harvest those losses but stay invested, so eventually when, the investment comes back, or you can kind of have those gains in the long term. So, where this strategy doesn't work, or where you shouldn't kind of put into play is, like Anthony said before, IRAs, all that money is tax deferred anyways, so you don't have to worry about tax loss harvesting there. If you have a year where maybe you have your income's lower than what you think is going to be future years, maybe it makes sense to not harvest those losses because you really don't have ordinary income or gains to offset. So you can kind of leave that invested. Sometimes it might even be where you have significant gains, and maybe you're going to look to just pass those investments on to your beneficiaries. So they're going to have a step up in cost basis. So maybe it doesn't make sense to try to offset gains or losses there either.
Yep. And for those of you that don't know, a step up in cost basis, essentially, if it's like a brokerage account and you pass away, those that inherit that account is going to let's say you bought ABC stock for $100 a share back in 1920.
That's a long time.
A long time ago. And now it's worth $2,000 a share. So essentially, your beneficiaries are going to inherit that new cost basis at the time of your death. So it'll be $2,000 a share. So if they were to sell it, it's still $2,000 a share. They don't pay the capital gains on that.
Right.
Because that is essentially the price that they essentially bought it at. Yeah, so you wouldn't have to worry about that.
Yeah. So kind of a lot of things to kind of keep in mind as we approach the end of the year. So far, a decent market.
Knock on wood.
Knock on wood. And, if you haven't done any tax loss harvesting, or maybe you've sold this year and you've had some investments for the last 2-3 years, we've had some significant gains. So you've probably realized some gains. So really trying to find ways to offset those gains is important as we approach, December 31st. So.
Yeah. And if you haven't talked to your advisor about some of the things that you've been doing this past year, let's say you did sell a property, you sold an asset where you had a significant gain, please mention that to them, because that would be good information to have.
Yeah.
So they know that they should be doing their tax loss harvesting this year.
Yeah. Yeah, we can't stress that enough to, keeping your advisor up to date on your entire financial situation is probably one of the things people don't think about enough. Because it's all related. Even your CPA, having your CPA and your advisor working together is another, important thing that you might want to consider because they're, although two different fields and they're doing two different things, they are related.
For sure. I just had a conversation with someone on Monday about this, talking about introducing me to their CPA. And he's like, do you guys work with CPAs at all? I was like, all the time.
Yeah.
Like our worlds blend so much, but there's that little bit of gray area. Like we don't do the whole tax,
Right.
the tax side of things, and they don't really do the investing side, but we do need to talk. So if there is something that your CPA is aware of that we're not aware of, it'd be great for us to have that connection.
Kind of recap. 1, tax loss harvesting, super important. You can do max $3,000 in losses per year, and if you have more than that, the rest just carries forward indefinitely.
Yep.
You have the wash sale rule,
Yep.
which 30 days you cannot buy the same investment.
So that's like if you had Apple and sold it, you cannot buy it back within 30 days and still get your loss.
Yep. So that's where it comes into play, where you can't do it really for individual stocks, but ETF, if you have an S&P 500 ETF, you could sell that S&P 500 ETF and buy a different company's S&P 500. So you're staying invested.
Mm-hmm.
So that does not apply. The wash sale rule does not apply to that. And really the tax loss harvesting doesn't really apply to IRAs. If you have IRAs and you have your gains,
Keep them in there.
Keep them in there. or look to, you can kind of realize those gains and not have to worry about paying tax on that until you take your distribution. So,
Yep. Good point.
Cool.
All right. Well, thanks for joining us today.
Yeah, we appreciate you guys tuning in. As always, if you have questions regarding your investments, tax loss harvesting, wash sale rules, or anything else we talked about, we're always here to answer those questions.
Happy to help where we can.
All right. Thanks, guys.
Thank you.